I'm Max Keiser, and this is the Keiser Report. Yeah, buddy, yeah! All right, Stacy Herbert, what do we got?
Bang, bang, you might say. This is the theme of the show, Max, because lots of banging going on in the markets here, and of course, led by the CEOs and bankers right behind us in the city of New York. Highest paid U.S. CEOs are often fired or fined. Study. About 40% of the highest paid CEOs in the United States over the past 20 years eventually ended up being fired, paying fraud-related fines or settlements, or accepting government bailout money, according to a study released on Wednesday. The report was by the Institute for Policy Studies, Max, and it appears that a lot of CEOs, the top paid ones, you get paid to defraud.
Well, I've explained this many times before. A board of directors of any S&P 500 company in America today wants the CEO implicated in some crime, committing malfeasance, committing fraud, subpoenaed, or in jail because it shows initiative. They want to push the edge. They want to go that extra mile. They want to break the law, and then they want to throw it to the Justice Department and say, nah, 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 nah. Eric Holder can't catch us, ha, 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 ha. And then if they do get caught, they change the law, they modify the law, they rewrite the law, and that's what it's all about, breaking the law. I'm for law and order. Bring back the death penalty! Bring it back! Bring it back! Yeah, ma, yeah!
Then the biggest criminal in the news, the biggest bang-banger in the news this past few months, in fact, has been Jamie Dimon, and he's in the next headline. Uncle Sam comes calling. Ask Jamie Dimon for another $6 billion. So the Federal Housing Finance Agency, the FHFA, is asking for $6 billion from Jamie Dimon's JP Morgan for defrauding the taxpayer about mortgage-backed securities. These are put-back claims. So the FHFA said the bank, JP Morgan, falsely claimed that loans backing $33 billion of mortgage-backed securities complied with underwriting guidelines, and that it significantly overstated the ability of the borrowers to repay their mortgage loans. Of course, Keiser Report covered this years ago, where at the time JP Morgan was saying that they were only putting aside reserves of $1 billion for these put-back claims from the FHFA. And Terry Buell, our guest, said that it would be closer to $9 billion. Here we have $6 billion. JP Morgan itself is refusing to pay this, so it'll still be in billions that they have to pay.
Well, it could be $1 billion, it could be $10 billion, it could be $100 billion, it could be $1 trillion. It doesn't matter because they just go over to the Fed and they print up more money. And then they will, of course, debase the currency. And to keep the currency from inflating too badly, they'll start a war and have a lot of servicemen go over there and get killed. That's the deflationary offset for the inflation that helps Jamie Dimon sleep at night, because he's not happy unless a lot of people are dying and he's defrauding the government in a big way. In other words, here is a marshmallow gun. This is what Eric Holder uses to penalize financial terrorism, or a financial terrorist like Jamie Dimon. This is a marshmallow gun. So Jamie Dimon is like, the Al-Qaeda of banking, and he'll commit a massive act of financial terrorism. People will die. People are starving. And Eric Holder will get up there and say, hey, Jamie, I'm going to hit you with my marshmallow gun. Woo, baby. Oh, that hurt. Oh, I can't take it, Eric Holder. That's so painful for me. Oh, that marshmallow gun you hit me with. I'm so rich.
Well, of course, the Eric Holder, the SEC, all the various agencies, the state attorneys general, like in New York, all right, keep on fining these guys. But it's just emerged that these banks have spent $100 billion so far on legal fees, just on legal fees. Of course, that dwarfs what they've paid in actual fines, because of course we know they're never fined for anything.
Right, of course the lawyers are corrupt. The accounting firms are corrupt. The rating agencies are corrupt. The hedge funds are corrupt, and the banks are corrupt, and Eric Holder is corrupt, and Barack Obama is corrupt. They should go after them as a syndicate under RICO and put them all in frickin' jail because they suck.
Well, the biggest market of all, I would ask you, but I bet you'll know the answer, is the currency market. It's the foreign exchange market, the Forex market. And that's in this next headline. Currency spikes at 4 p.m. in London provide rigging clues. So there's $4.7 trillion in currency exchanged every single day on global markets. It's the least regulated of all, and it's concentrated in just 4 banks who control about 50% of the market. Number one is Deutsche Bank. They control 15% of the foreign exchange market. Citibank is just under 15%, making it number 2, and tied for 3 and 4 are UBS and Barclays, each at 10% of the market. Now, Bloomberg talked to some people and investors and experts and professors at NYU who looked at this, and it looks like they're basically banging the close. So before we move on to the details, tell us what banging the close is.
Well, banging the close is like painting the tape. In other words, you want to, what I call price propaganda, as I've said on this show many times. You want to have a price that the newspaper will then carry as a headline the next day, and this will set the tone for the next day and will set you up for manipulation the following day. So banging the close in this case could mean just dumping a lot of orders in at the close, what are called market at close orders. So you put in a lot of market at close orders, and those orders have to be executed at the market. If there's a whole rush of them either to buy or sell, you're going to create a price movement. And if you've got other offsetting trades in other markets that are going to benefit from the price in, let's say, the stock market, and you might make money in the options market. You see this on triple witching hour, which is the simultaneous expiration of options, futures on options, and stocks and options on stocks, and you have this all happening every quarter. So it's a way to essentially just write a check and put it into the pockets of the big banks for doing nothing but being fraudulent.
Yes, so Bloomberg looked at years of data, and they found that, in fact, there was huge amounts of evidence for rigging, because basically at the end of every month, there was always a price anomaly half an hour before trading closed, and it was costing investors, pension funds, passive fund investors.
What's remarkable about this is that we've seen over the past few years a move toward what's called big data. So the ability for the government and corporations to delve deeper into the transactions and the specific data, tick by tick, kernel by kernel, is extraordinary. So the culpability, the fraudulent activity, is never been clearer. There's never been a greater evidence than now that Citibank, Deutsche Bank, Goldman, JP Morgan, the whole lot of them commit fraud hourly, minute by minute. And yet, simultaneously, we've never had a weaker Justice Department. Never have we had such a limp, weenie Justice Department. Anthony Weiner, he should run the Justice Department. He's got the right equipment to run that department. He's all limp about it. He can't do a single gosh darn thing. That's what it's a match made in heaven.
So let's talk about this banging the close in the global Forex market. It happens via London, of course, but here's Bloomberg's data. They looked at the data, and this is what they found. In the space of 20 minutes on the last Friday in June, the value of the US dollar jumped 0.5% against its Canadian counterpart, the biggest move in a month. Within an hour, 2/3 of that gain had melted away. The same pattern, a sudden surge minutes before 4 p.m. in London on the last trading day of the month, followed by a quick reversal, occurred 31% of the time across 14 currency pairs over 2 years, according to data compiled by Bloomberg. For the most frequent traded pairs, such as euro dollar, it happened about half of the time data showed. The recurring spikes are happening in the WM Reuters index. This is the World Markets Reuters index.
Right, okay, indexing is another way to accentuate the fraud, because now you have indexes that have a basket of these underlying prices, and if you can manipulate the components in the index, you're manipulating the index itself, and so much of the market is tied to indexes. The famous one being the Dow Jones Index, and there's a lot of contracts and products like a SPDR Dow Jones exchange traded fund tied to an index. That index, made up of all the component stocks and the options trading on those stocks, are completely manipulated, as we know from the Bloomberg story. Concurrently, I might add that if you can manipulate the Forex market every single day, then you are, by definition, also manipulating gold and silver. So that's why gold and silver have had such a tough time getting through the manipulative ceiling to put the money into the pockets of these terrorists.
That's a conspiracy theory, though.
No, but I'm saying, why send drones down to Syria? The terrorists are there, down on Broadway and Broad Street. Do you have a map? They're stupid. How did America produce, and the UK, it's a castocracy. They put the stupidest idiots in office, Obama and Cameron.
Democracies tend to get the fools they deserve. That's what W.H. Mencken would have said. But regarding this story here, a lot of the fools who vote these sort of people in a democracy, one thing that they will think is, well, it's only 0.57% that this particular exchange, the dollar versus the Canadian dollar, that's only 0.5%. It's tiny, 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 tiny. I, the individual who was just trading $100 Canadian dollars into 100 US dollars, wouldn't have noticed that. So they look at this, in fact, it's a $4.7 trillion per day, and it adds up to tens of millions of dollars per day that these banks are making off of these trades. So they look at this particular trade at the last day of June this year. An investor seeking to change 1 billion Canadian dollars, 950 million US dollars into US currency on June 28th would have received $5.4 million less had the trade been made at the WM Reuters rate instead of the spot rate 20 minutes before the 4 p.m. window. They speak to James Cochrane, an expert here in New York who looked at this technical data, and what he said regarding this consistent banging the close. He said funds that consistently trade using the WM Reuters fix are basically trading against themselves, and their portfolio is taking a hit. This is tens of millions of dollars every single month taken from pension funds and passive investors.
I think James Cochrane is right in his analysis of the situation. And basically it's the psycho model. You remember in Psycho, the young psychotic is, in the end, murdering his own mother.
Norman Bates, yes.
Yes, Norman. So America is in a position now where it's an old hag and it's murdering itself, thinking it's somehow achieving economic growth. So there's America knifing and raping itself in the mirror over and over again. Okay? There's America raping and murdering itself over and over again in the mirror. You know, psycho. They're really good at it. Self-rape, America. Visit today.
Well, so, you know, again, pension funds and money managers pay their foreign exchange using this rate. So they're the ones being self-raped by this what you indicate here. But I want to, you know, you talked about bang bang and that the Justice Department is using marshmallows when prosecuting these bankers. So I want to close on this final quote here from Bloomberg. Because they receive client orders in advance of the close and some traders discuss orders with counterparts at other firms, banks have an insight into the future direction of rates, 5 dealers interviewed in June said. That allows them to maximize profits on their clients' orders and sometimes make their own additional bets, according to the dealers who ask not to be identified because the practice is controversial. So they're making huge amounts of profits. This is why you have quarter after quarter after quarter after quarter after quarter after quarter where banks report no losses on their own trading books.
All right, Stacy, thanks so much for being on the Keiser Report.
Thank you, Max.
Yeah, hold on more, baby. Yeah, stay tuned. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Geneva and speak with David Smith of Geneva Business Insider, blogspot.com. David, welcome back to the Keiser Report.
Pleasure to be with you, Max.
All right, David, the flow of gold from London to Switzerland in the first half of 2013 stands at 798 metric tons, the highest amount since 1988. What's going on?
Well, it's a very interesting trend, but what you have to remember is that Switzerland is one of the major centers for melting of refining and finding gold. So the move actually reflects gold being transferred to London to be prepared and for shipment out to Switzerland. So what you're seeing is that these refineries are now running more or less at full capacity, sometimes on 24-hour shifts, in order just to process the amount of physical gold that's coming here. But it would be erroneous to assume that this gold is actually staying in Switzerland. I think most of it is probably making its way out to the Far East, to Hong Kong, to India, etc., to satisfy demand in that region.
Well, as part of the effort to keep the price of gold down, Bank of England has been leasing gold, and they've been leasing gold of countries that they should have held as custodians. And we just found out recently that they're missing about 1,500 tons of gold, custodian gold. So apparently, not only have they leased out their gold for other countries, but they're shipping it to Switzerland, and it's going to be shipped off to China and India. So what happens when they have to make good on these claims, when these countries start like Germany wants 300 tons from New York, and New York saying, no, you can't have your gold. Are we setting this up for a run on the gold, on the sovereign gold market, David?
Yes, I think that's the case. I mean, what is happening at the moment? I was speaking this morning to a friend at Global Gold, Claudio Grass, who's close to the physical market. He's saying he's seeing a lot of physical gold coming here, but in large quantities, and the buyers of it are large institutions, the central banks, the big banks, to satisfy their requirements. And ultimately, there is going to be a breakdown in the physical market, although at the moment, it would appear that gold, while being tight, does not actually appear to be completely run out. But we keep seeing new sources of potential for gold. Anyway, if you look at what's happening in India, now talking about leasing gold, I mean, this will be most intriguing, because what is going to happen there is the gold will get leased, it'll get melted down, sent somewhere else. And no doubt when they ask for their gold back, they'll be politely told, well, you probably have to wait for 7 years as well. So if I were in the Indian central bank, the last thing I would do is be leasing gold to people in the certain knowledge that the future gold price can only go up when the scarcity actually really completely hits and there's nothing left in the warehouses. And I would lose out on the upside of the value of gold at that point.
Right. You say that there is some supply of gold on the market. However, we do see backwardation in the futures market, and which implies that there is no supply of gold. We also see go-forward rates in gold lease markets trading at inverted prices that would also suggest that there is no physical gold around. It's funny, this India story, because just a few years ago, right, they bought, quote unquote, 200 tons from the International Monetary Fund. Of course, that gold was never delivered to India. It's just an accounting entry. Now they want to turn around, and because of the crisis in India, because of the collapse of the rupee, and I note that gold is only within 10% of trading at an all-time high against the Indian rupee. This could be another all-time high against another currency coming up for gold as we enter a cycle of gold trading at all-time highs against all major currencies. But so they want to lease the gold that they just bought? Walk us through exactly the insanity going on in India right now, David Smith.
Well, I mean, India is in a pretty precarious situation at the moment. It's had a boom. Now you're seeing, there's a great deal of foreign investment into developing markets. India was seen as a hot market. The last few years, that's been slowing down. You're seeing a 30 or 40% drop in the currency rate, which is absolutely dramatic. It's greatly squeezing putting pressure on domestic costs and so on. There's capital flight from India, obviously, because if you're investing in the currency which is collapsing, you want to get out. And believe it or not, many people are actually getting out to the security of the US dollar, which is yet once again one of the world's biggest jokes. So what you're having, I think you picked up very correctly on, is the fact that in rupee terms, gold is being perceived as a very good investment, because it is rising as the currency is collapsing. Gold is rising in rupee terms, which is exactly what's going to happen ultimately in dollar terms or sterling terms or euro terms, no matter how much the would-be oppressors of the gold price try and push it down. So I am very happy to see the little housewife in India buying herself 1 ounce of gold or whatever, because after all, there's a population of over 1 billion. There's a culture of gold being a store of value and currency. So if these very small purchasers in India keep on going, the effect on the overall gold market will be dramatic. And the other very interesting thing we're seeing at the moment is just how porous the borders are between India and their neighbors when it comes to smuggling gold into the country. It's almost as porous as the border between the US and Mexico for cocaine. So I can only encourage those people to keep keeping the gold and forget the cocaine.
Yeah, it seems that, well, the black market in gold now is the biggest black market in India. People buying gold and silver too. And this has been the big surprise, David Smith. During the last 3 or 4 months, the cartel, or the London Bullion Markets Association, in conjunction with the COMEX and bankers like JP Morgan and HSBC, have flooded the market with hundreds of thousands of paper claims against gold, that they basically have counterfeited on these various futures exchanges, hoping that people would dump their gold and get discouraged about owning gold. But the exact opposite happened. Queues out the door all over Asia, China, people clamoring to buy gold. They completely misjudged this market. Correct, David Smith?
I think it's the biggest central planning blunder in a very long time. But like so many other central planning blunders, once it's made, they just keep on doing the same thing again. Our old definition of insanity. But yes, I mean, it has made the small buyer in developing countries very keen. It scared off probably the kind of middle-class, semi-affluent person who was buying paper gold and got smashed in the teeth. So, but it stimulated enormously the physical market. And what is going to bring an end to all the corrupt manipulations which are going on in gold is only when the physical amounts of gold cease to be available. And if you're looking at what's happening in the COMEX vaults or the LBMA or the JP Morgan vaults, you know, they're not quite running on empty, but they're getting close to it. Now, I'm not imagining that JP Morgan will not be able to put its hands on physical gold by fair means or foul, either by squeezing it out of the ETFs or out of client accounts or doing whatever they usually do to save their own skin before everyone else's. But there has to come an end to this. And I think the end is on the horizon. Now, whether the end is going to come in a week or a month where there's a technical default where the COMEX suddenly starts settling in paper dollars instead of physical gold, I really have no idea. But the certainty is there that the demand for gold is going to overwhelm the central planners and the manipulators of the paper markets.
All right, so David Smith, you're there in Switzerland, surrounded by lots and lots of rich people. You yourself have a career in managing the wealth of high net worth individuals, et cetera. And you mentioned the U.S. dollar earlier, and some people are buying dollars as they get out of these currencies like the Indian rupee. But my question is, the wealthy in Switzerland and around the world, if given a choice, are they going to, A, buy the dollar thinking that the world is heading into a deflationary depression, or B, they're going to buy gold thinking that we're heading into more of an inflationary depression? Your thoughts?
It's a difficult question. The reality of the world is that the very wealthy people are correctly advised and are stacking gold. Now, I'm not talking about the guy with, you know, a decent salary and who's paid off his mortgage, but people with substantial assets are allocating already considerable amounts of money to gold as a long-term resource. Now, what is going to happen, whether there's going to be an inflation and then deflationary depression, goodness only knows. It depends a lot on what Mr. Bernanke does with his tapering and his bonds and all the rest of it. But rest assured, the wealthy and the powerful are filling bank vaults to the point where the banks are actually having to build new vaults and new storage capacity to store the gold which the clients want to hold. And most people realize that sooner or later, the dollar's demise is inevitable, but because it's the world's reserve currency, it's going to be the last currency, I think, to sink.
All right, let's move on to Greece for a second. It appears that Greece is on the verge of requiring another very significant bailout. Should the Greeks expect to be Cyprus this time? In other words, will it be a bail-in this time? Will it be confiscation from bank accounts this time, David Smith?
Well, I think the answer is definitely yes. If you look at Merkel's position on this and the admission recently by Schäuble that there needs to be another bail-in, there's great resentment in Germany about this, which has political consequences. But if you look at the solutions, Greece will never, ever be able to generate enough tax revenues to pay off debts. It's doing quite a lot to sell off assets to, basically, they're being asset stripped by the Chinese and multinational companies, etc. But if there's a hole left at the end of it, then the best thing to do, of course, is steal the money from the depositors. So, you know, at the moment, legislation is being put in place globally by the central banks and implementing this through their politician servants. to bail in wherever you go. So this is an inevitability in many countries, not just Greece.
All right, David Smith, we only have about 30 seconds left.
Yep.
I'm hearing rumors about Deutsche Bank as being the next Lehman Brothers. That's what I'm hearing. I realize that's a bit of a interesting rumor circulating, but I understand you've been hearing some rumblings about Deutsche Bank. What do you hear?
Well, I think Deutsche Bank is definitely on the ropes. It's a bank which is financed by international money and not by depositors' money. Its true leverage is probably around 60 times its asset base, and it has the biggest derivatives position in the world. It's something like 55 trillion. And I would not like to see what's happened to the derivatives book in the last few days when we're seeing the interest rates rising, because they have global exposure to derivatives in the US in particular, where 10-year yields, which are the benchmark very often, are soaring and doubling in the last few weeks.
All right, David Smith. So Deutsche Bank leveraged 60 to 1, which is about where Lehman was before it imploded. We're out of time. Thanks so much for being on the Keiser Report.
Pleasure to be here once again, Max. Thanks a lot.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and the lovely Stacy Herbert. I'd like to thank our guest, David Smith of Geneva Business Insider, blogspot.com. If you'd like to get in touch, tweet us at Keiser Report. Until next time, Max Keiser saying bye, y'all.